See, this is illustration 1. This is one company, Newton Limited, which is incorporated on 1st of January 2013. It issued a prospectus inviting application for 20,000 equity share of rupees 10 each. So, this is the company newly incorporated, and it is inviting application from the public for 20,000 equity share of rupees 10 each. The whole issue was fully underwritten by three underwriters, Adam, Benjamin and Clayton. So these are the three underwriters who has fully underwritten the whole issue. Adam 10,000 shares, Benjamin 6,000 shares, Clayton 4,000 shares. So total 20,000 shares has been underwritten, which is the total number of shares. Now the application received from the public is 16,000 shares, of which marked application were as follows. See what happens now. The marked application, Adam, Benjamin and Clayton, these are the three underwriters. So if the public is not able to subscribe, then these three people has to subscribe the shares of the company. So these three underwriters will promote public to subscribe for the shares of that particular company which is underwritten by them, obviously. So they will move their applications towards, they will forward the applications to the public, and each and every application which the underwriter forward towards the public is marked by their own name, or you can say that there is a rubber stamp on each and every application which the underwriter give to the public. Say I'm an Adam, right? I'll promote public to subscribe the shares of the company. Then I'll put the stamp on that application, and then I will give to the public, so that that particular person who is subscribing the shares of the company will be marked under my name, because I bought that person, I initiated or I persuaded that particular person to subscribe the shares of the company. So that will basically reduce my liability, because that will be marked under my name. So in the same way, Benjamin and Clayton, which are the other two underwriters, will also forward the applications by putting the rubber stamp on that application and will forward into the public, and whatever number of applicants subscribe the shares, and then that particular number of shares will reduce the liability of the respective person. So the application which has been received is 16,000, of which marked application are as follows. It means that 8,000 shares are basically marked under the name of Adam, 2850 shares are marked under Benjamin, and Clayton 4150 shares are marked. So basically the total of 8,000, 2850, 4150 is 15,000. So 15,000 are basically the marked applications which the company has received, and 1,000 is still remaining, and 1,000 is the unmarked application. It means these are those applications basically which are not marked by any of the underwriter. It means that someone from the public directly come to the company and subscribe the shares. They are not coming through any underwriter. So it means that out of 20,000, 15,000 is marked, 1,000 is unmarked, and the remaining 4,000 is not at all subscribed by the public, and that will come upon the underwriters to subscribe, right? So now in this question, we are required to find out the liability of the individual underwriter. Now we have to find out the liability of the underwriter. See, the solution of this example is statement of net liability of the underwriter, Adam, Benjamin and Clayton. So the gross liability of all these three are given in the question, say 10,000, 6,000 and 4,000 shares. So they are liable to take 10,000, 6,000 and 4,000 shares if public do not subscribe. So this is the gross liability, and out of that, marked applications are 8,000, 2850 and 4150. So basically, if I say 8,000 applications are marked on the name of Adam, so remaining are just 2,000. And if I say Benjamin, 6,000 is the gross liability, out of which 2850 is the marked application. So the remaining will be 3150. So if I say about Clayton, 4,000 is the gross liability, and Clayton is able to attract more people, or they are able to grab more marked applications, which is 4150. So so probably Clayton will not have any liability to subscribe for the shares. So now what will happen to the unmarked application? This unmarked application will be distributed among the underwriters in the ratio of their gross liability. So the ratio of gross liability is 10:6:4. So the total 1,000 application will be distributed among Adam, Benjamin and Clayton in the ratio of gross liability 10:6:4, which will give the figure of 500, 300 and 200. So the total shares, or you can say that the total of 16,000 will be distributed among the underwriters, and the total will be 8,500, 3150, 4350. So the total 16,000 is distributed among the underwriters. Now we can see that there is a surplus in the Clayton. So this surplus will also be distributed among the remaining underwriters. So the 350 will also be distributed among Adam and Benjamin in the ratio of 10:6, which is their gross liability. So 219 and 131 will be the additional benefit to the Adam and Benjamin. Now the total will 8719, 3218 and Clayton will be at par, which is 4000. Now the net liability of Adam and Benjamin will be 10,000 minus 8719, which is 1281, and for Benjamin it is 6,000 minus 3281, which is 2719. This is how the net liability needs to be worked out. If there is any over application, it needs to be distributed. If there is any unmarked application, it needs to be distributed in the ratio of gross liability, and then final net liability of the underwriters is calculated. So this is how the question needs to be solved.